Welcome to the Two Stewards Show. Insuring things is a favorite pastime for many in our modern world. The blissful feeling of having all your stuff covered in case of disaster has no parallel. It is such a source of joy that average people get insurance on pretty much everything they have. Houses, cars, health, income, crops, yachts, travel plans, pets, jewelry, and more. But sadly, thanks to inflation, average people can now afford fewer things and thus have fewer things to insure. Even the simple pleasures of life are being stripped away. Thankfully, as always, insurance companies have our back. They've spotted this trend and mercifully invented a new product. The only catch is you have to be alive. But finally, there is a way for average people who don't own anything to be happy. Today, Adam Niman is back to explain whole life insurance. What is it? How does it work? Is it possible to use insurance to become your own banker? To get in touch with Adam, check out nimanfinancial.ca. As always, if you have general questions, guest suggestions, or content indigestion, you can get a hold of Mark and myself by emailing hello@twostewards.ca. Remember, this show is not financial advice, but is valuable for listening amusement purposes. And now, the joys of insurance. I love 5-star reviews.
Don't we all? Today we have with us previous guest, Adam Niman. Niman.
Last time. So.
Nailed it.
We're off to a great start. Adam Niman of Niman Financial, Inc. and a bunch of other companies, but I'll let you, Adam, why don't you introduce yourself, Adam, and tell us what you do, and then we'll get into it.
Adam Niman, I guess financial advisor. I sell life insurance and I sell benefits plans. That's about it. You know, I'm an overall real estate investor. Invest in crypto, invest in stocks, never a bond. I tell people this: I will never own a bond unless I am drinking from a straw in my life. That's my goal in life is to never own a bond. Okay. You know, if I own a bond, that's because I'm like out of commission and I'm still alive. You know.
Maybe some of the strategy bonds they put out.
Yeah. Maybe those are that's the exception. You need to be special, I feel like, to get in on those.
When you say crypto, do you mean all types of crypto, or is it like Bitcoin only, or?
So
we're trying to assess your character by the types of crypto that you invest in.
I'm gonna cascade down. Okay. Primarily Bitcoin and Ethereum.
Yeah.
Because I do really believe in what it's trying to accomplish. And then
making Vitalik Buterin rich?
Sorry?
So carry on.
It's not like he holds the majority of it anymore, right? The Ethereum Foundation is a minority holder of these coins, and they were selling them off. But I do believe in programmable money. I do believe in the tokenization of assets on the Ethereum chain. And then from there, I do hold some other smaller cryptocurrencies, not because I believe in them long term. In fact, I don't. They can't all be successful. But I think that the Trump family is selfish enough and crypto is in the news enough that the entire market, I believe, will run on speculation. And I do have positions in smaller coins that my idea is to get out of in the next 2 to 3 months, because I think we are going to have that final phase. I think it will happen. I don't know what the final phase will look like, but I have been successful in trading, doing a little bit of trading and trading strength between these coins. So you look at the Ethereum strength versus, let's say, Avalanche or Ripple or Sui or some of these other small ones. And then I'll move in and out of positions just because everything's on chain and it's pretty transparent. But in terms of actual utility, I think most of it's going to come crashing down, similar to the dot-com bubble. That's what I see happening. You're going to have this big run-up because of all the speculation, because of all the institutional adoption. But really, in the long run, we probably only be a handful of winners. And I do believe Ethereum is going to be one of those because of the tokenization, the programming of money. I do a lot of my private investing life. I realize the utility in programmable money and how much administration and money gets lost in just trying to confirm that someone has something or transfer value from this person to this person in the context of what they own, whether it's like a cap table or whether it's a mortgage, like programming money and not having to use institutions or third parties to manage who's title to something or payment processes is incredible and is important. Will it be Ethereum? I'm hoping because I've invested in interest in it, but like I really don't know,
Yeah, you can.
Where are you on there?
Yeah.
You think it's all BS other than Bitcoin?
We're Bitcoin only, absolutely.
I got it.
I was talking to my kids about it because they have a little bit of Bitcoin now.
So you don't like Gymcoin or?
Well, my son
What about
was,
Pepe?
No, my son was quite interested in Fartcoin.
Fartcoin.
They thought that was great.
I wonder why, the coin that's the funniest to me is XRP.
Okay.
It's because
Why?
Because I understand like what they were trying. The whole idea was supposed to be like an intermediary, right? A transfer payment system. And man, like if there is I call infinite banking a cult, Ripple's a cult. Like the amount of people that like love Ripple, it's impressive online. It really is. And at a high level, you're like, okay, I know what they're trying to accomplish. I don't understand the technicalities of crypto, but like more than most, but I still don't believe in like utility of the vast majority of it, majority. Yeah. And then you hear what Ripple's trying to accomplish and you're like, okay, that makes sense in theory. And then you have stable coins kind of over the last year come out of nowhere. Yeah. I think they saved the Western financial system. Old people don't realize it because the only reason rates aren't going up is because all these stablecoin issuers bought up all this debt. And that's why these acts were passed in Congress, because they needed someone to buy up all the debt. Yeah. So by digitizing fiat, I'm putting it on chain. What do you need Ripple for anymore? That's the way I see it, But right before Trump was elected, I was betting that he was going to win, and I bought a bunch of Ripple at I think I bought a bunch at 80 cents. I put in 30 grand at 80 cents, and then it ripped, and then I sold it into Ethereum, and then I got destroyed.
I think listeners like to hear those stories.
I got destroyed. I was like, oh, because I made so many. I made so many stupid trades in the weed boom. I would be trading risk for higher risk stuff, thinking I was being smart, and I lost my shirt. And then suddenly I was like, oh, Adam, you did a smart job here. You made a speculative play on a bet. You quadrupled your money. You sold half, right? And you put it into a stronger asset, right? Yeah. Wrong.
For listeners who aren't watching, Adam does have a shirt. So
Yes.
Exactly. It would have been nicer if I wouldn't have done that trade, But at the same time, I believe in Ethereum, and as it dropped, I kept buying it. And we'll see what the rest of the year has in store.
Look at you now, right? It's it's up there, right?
Yeah, I think it's when I checked, it was 6,300 Canadian, which is pretty cool because I bought it at I remember I first bought it at $10.
Yeah.
Which is wild,
Crazy.
Yeah.
Well, there goes our 10-minute tangent.
Yeah.
So.
No, I'm a little bit interested in what you're saying about Tether. So number one, what an incredible company, right? They have 50 employees and make
billions.
Yeah, isn't it the most value per employee other than OpenAI or something?
Oh yeah. Crazy. But you're sort of suggesting that the US has already kind of moved towards the stablecoin model, right? People have talked about that a lot, and I know this is probably not everybody's interested in this or whatever, but it's so important to the survival of the US and for them to have a market for bonds so they can keep piling on debt.
Yeah, and Tether's 93 million per employee in last year.
There you go.
Holy cow.
Which is wild,
I mean, they're one of the biggest single holders, I think, of U.S. debt, right?
If I worked there, I'd probably ask for a raise.
Yeah, totally. They'd issue you stock. That's what they would do. Exactly what they would do.
Oh, man. And so, people have been talking about it's coming. But do you think it's sort of already de facto happened? There's not an official policy.
This is just my this is just my opinion as someone who has dabbled in it on and off.
Yeah, it's not financial advice.
Right? No, definitely not. I see as the last thing to be digitized in our economy, in my opinion, is money, because
Right.
it's the hardest thing to digitize. Everything becomes digital in this world. You had the internet, that was the first wave. And when you see the adoption, I think we are now at, I believe, the second leg. So if you were able to get in early, 10 years ago and hold on till now, like, power to you, because the likelihood was as close to zero. Like, most people would have sold out.
It was a gamble at
Yeah, it
that
was such a
point.
gamble. Not to mention, like, I had some money in Quadriga, the guy who passed away. Like, you thought your money was on exchanges, but it was probably in a Ponzi scheme. So it's easy to say, I bought Ethereum at $10. If I would have, well, yeah, but you would have probably had it on an exchange that was maybe in a Ponzi scheme. Like, you didn't know what was happening. It was so easy to make, but it was also so easy to lose. And then cashing out of it is a whole nother problem.
Yeah.
So the first wave with the early adopters who had a little bit, I would say, like, the balls or maybe the belief that it would become normal. But now I feel like the next 10 years is the adoption.
Right.
If you can, I believe that if you can get in right now and hold for another 10 years, like, you will do extremely well. How well, like, I have no idea, but I can't help but feel like there's a massive place for the ability to program money. When you think about, let's think about, like, insurance for a second, or financial institutions or trusts. Like, most of what we do is just hoping the right thing is done with our money in life and when we're not here. And if you could tell your money what you want it to do and it happens without having to trust a third party to do it for you, like, that is, I think, significant. Like,
It's
beyond
interesting.
significant.
Yeah. It's very empowering, right?
Yeah, totally. Like, I think about wills, right? You write down what you have. You write down where you want it to go.
Not to the government.
Yeah, and you hope that they do the right thing, and you need really smart people who went to school for a long time, because you hope that those type of people are more likely to do the right
that
thing.
hopefully have a whole bunch of 5-star reviews.
Totally.
And your parents.
Yeah,
and, your
and have
family,
insurance,
yeah.
right? They need to have insurance, right, to make sure they do it properly. But it would be much better if I could, like, just program my Apple Watch that, like, when my heart stops beating for 5 minutes, like, my money automatically goes to these wallets without having to go through a bank or through an institution. Or even think about car insurance for a second. Like, my car's, like, parked out here. Like, in my opinion, the risk that I should be paying should be reflective of the risk that currently exists if something happened, not an aggregate of, like, what they think based on how much I drive over the course of a year. Like, there's programmable money solves so much. It really does. So much that it's mind-boggling to think about. Look at taxes and investments. If I could program my money, like, I shouldn't have to file my taxes.
Try not to look at taxes.
Exactly. But, like, it should all be automatic. Like, it's all calculations, like filing things, like bookkeeping. It should all happen. You don't need people to do this stuff anymore when it happens automatically.
Yeah.
There's just a massive opportunity with programming money. The question is, what money is valuable enough to be programmable and decentralized enough and trustworthy enough? And right now, that's Ethereum. Will it be that way in 10 years? I don't know. Like, Vitalik could be pulling the most epic rug pull ever. Like, it could be, right?
And it's not Bitcoin.
Sorry?
It's Ethereum, but it's not Bitcoin.
Well, you can't, as far as I know, I'm not, like, a maxi here. I'm not, like, a technical guy, but as far as I know, Bitcoin isn't programmable in the same way.
Yeah.
Like, it's just not.
Yeah.
No one party can change the code and
Right.
yeah.
Yeah, it's almost a feature of it.
Yeah,
So.
it is totally. That's why it's digital gold, and they call Ethereum digial oil.
So
right,
does
for
that mean
reason.
that the central organization who controls the programmableness of the money would have, would it basically end up being the government and we get CBDCs? Like,
I don't know. That's a really good question. Yeah, that's why it's so speculative.
What's that?
We got a USB stick. We're recording this. Okay.
Well, like, listen,
You have such a phobia. He's got a medical term for that.
I don't know. Like, you're totally right. Because I'm not a programmer. I don't know enough about Ethereum. For all you know, they could program something that's in their own self-interest.
Yeah.
Yeah, that's why it's such a risk. That's why if you take the risk now, you could be rewarded for it, and if you take the risk now, it could be an absolute failure.
Yeah.
That's why it's a very special place to be, because there's definitely going to be winners and losers. And for all you know, someone who is in the know when it comes to the technicalities finds this out, and maybe one of these other sleepy coins actually turns out to have the most utility and the hardest to break and the safest, and eventually becomes the winner. Maybe that's XRP. I don't know. But that's the speculation.
We'll have you back on when that one shoots up.
Totally.
Yeah, okay.
Ripple's going to 10,000 a coin, Jeez. God willing, that'd be great. But
oh man,
it's hard to say. Listen, I think it's fair. I think we can all agree that money is being digitized.
Yeah.
The question is not if. The question is what and when and to what extent.
Yeah, and who controls it too, right?
Totally.
That's another big aspect of this. Who is the one programming it, and who is the one who can control the issuance of it, or like you said, the surveillance of it, or who sees
who's
behind
on
the
first.
scenes. Yeah.
Totally. I almost feel like when you're growing, you don't have to actively decide when and how much blood you pump into your system. It happens automatically and in tandem through a very complicated chemical process that I'm sure some people understand. But if we could mimic, we would. You can't create humans, in a lab.
Yeah.
You really can't. But obviously there is a way to do it because it's done. A womb is a lab, but we don't know what that is. And I almost feel like these digital currencies hopefully will act in the same way. They will be sometimes inflationary, sometimes deflationary, and their supply will move based on the needs of the economy that it serves. And hopefully it gets to the point that it can serve itself in a way. But the problem is your body can fail you. Cancer.
Yeah.
You can have everything working right and be the healthiest person in the world, and one mistake, a cell splits the wrong way, or you have one mutation, and that leads to a cancerous cascade. So just because a system is working and it's healthy doesn't necessarily mean something can't change.
Yeah.
And I view cryptocurrencies as a living currencies as the blood of a working economy, and I don't think it's working right now because the government manipulates the medium, right? They're things are only going up by 2%. Those tomatoes are only 2% more than last month. And you're yeah, but you printed 5% more money, and you took chocolate out of the equation because chocolate went up by 10x. That's what they do right now,
Yeah.
Well, whatever happens with money.
We're laughing, but inside we're
still,
crying.
We're crying, yeah.
Government's still going to try to control it. So
yeah, of course.
We'll see what happens.
People in power will try to control things that are big and valuable.
Yeah.
And I don't know about you guys, but sometimes I think you need a balance in life of looking at the micro and looking at the macro.
Yeah.
And you can't look too much at the micro because all these things happening around you matter. But at the same time, all these things that are happening around you, to what extent do they actually factor in to the micro? And you can't stick your head in the ground, but you also can't worry about it that much.
Yeah, it also seems like things are changing quite quickly too, right?
Yeah.
You try to stay on top of the developments in AI or cryptocurrencies or whatever, and it's well, I can't keep up.
You can't keep up.
Yeah.
I have a friend of mine that because I got way too comfortable taking too much risk for way too long, I put a bunch of money with a friend of mine who has his own fund, and he's doing a great job. And it kind of I love taking risk and I need to take risk, but I need it to be smart risk and not stupid risk.
Right.
And what I like about his fund is that he's looking for beaten down names that have a lot of potential upside, and I'll trade his advice. And what I'm realizing is that it's easy for me to trade and sell out of things when I'd made money while I still know that I have the holding in the fund, because you get FOMO, right? You're just I doubled, right? I'm going to sell and it's going to 10x. That's what everyone feels will happen, right? Yeah. But I'm allowed to kind of do that because I know that I have a smart person who's at the wheel. So fine, he had this name, it did extremely well. I'm going to trade out of it, but I don't get that FOMO feeling because I know that I'm still holding it in the fund. So if it does continue to go to the moon, as the kids say, in the fund, I still have a piece of it.
Yeah.
And I feel better about the fact that I made a good trade. I'm trying to be smarter with my stupid. That's really what it is. But I can't remember where I was going. with that.
It's controlling
There's a good
your.
title. Be smarter
Yeah.
with your stupid.
Yeah.
It's controlling the FOMO.
Yeah, you have to control the FOMO, which is hard, man.
So have you got a grip over that, or
No, it's like no, it's well. I'm trying to. Like, I definitely feel like I'm getting better. You know, it's going to be interesting to see what happens over the next like 6 months because like I think there's going to be some interesting opportunities in the crypto market. But yeah, I don't know because I also feel like half the chatter online is like we're about to crash, and the other half we're like no, but we're going to like top out significantly before we do.
Yeah.
But the whole point of like a crash and a black swan event is you can't predict it. So
Yeah.
something needs to
people
break,
are pretty-
right?
yeah.
Well, you have a loving embrace on this book in front of you.
Oh shoot!
and,
Yeah.
Yeah, we should get to that.
yeah.
Yeah.
Part of the reason we wanted to have you on, but becoming your own banker, is this your favorite book?
Yeah, totally. Yeah, I love this book. Let me tell you.
Okay, so we talked about this last time
Mm-hmm.
you were on. We talked about infinite banking, and you were not in favor. And yeah, you have I don't know. You can lay out quickly some of your reasons. People can always listen to the last podcast as well. But there's some. Yeah, not updates, I guess, but some, infinite banking has been making the rounds and people have been making predictions and saying things. And I think there's a few things that you wanted to address in that regard as well, right?
Yeah.
Just about, I don't know, advances in infinite banking.
Advances.
But just like maybe just touch on what infinite banking is in 30 seconds for people who have never heard of this.
So
Yeah.
it's
Like it sounds great.
Yeah, participating whole life insurance. It's investment grade life insurance as an asset class, and the idea is you buy this life insurance policy that has returns attached to it. So not only are you buying life insurance, but you're buying an investment, and the insurance company takes all these premiums that people pay into this participating policy because you're participating. You have a part of it. All the premiums go into one big fund. And just like any investment, they buy assets inside that fund. And at the end of every year, they pay out returns to the people who own all the policies in the form of a dividend. And that policy grows. And it's paid out tax-free because it's a life insurance policy.
Yeah.
And what infinite banking says is that you should make this kind of a core asset of your financial plan for the creditor protection, for the state preservation, state all these buzzwords. It's going to grow tax-free. You're going to get a consistent 6% return on your money, tax-free for the rest of your life. And as it goes up in value, you have access to the cash value, those dividends that you get every year, and some guaranteed cash value, some added and grew because of the dividends. You can use that as security for a line of credit. You can get a line of credit from the insurance company that holds the policy itself. You can get a loan at any time. You don't
And
have
that's
to,
where the idea of like being your own bank
Yeah.
comes from, is like you're actually, when you can go and borrow money, it's your own money essentially.
your own,
right?
yeah. Well, the idea of the be your own banker part is that if you borrow from CIBC, you're paying interest to CIBC and they're making the money. And the interest that you're paying to them is gone.
Yeah.
That's lost forever. You can never recapture that. But what if you were CIBC? This is how you are CIBC, because you now have a piece of the participating fund. So by you paying interest into that par account, that interest then comes back to you in the form of dividends. So you're not actually borrowing money, or you are borrowing money, but it's beautiful because you're borrowing from yourself and you gain the benefit of the interest. And like it's a great story. It sounds amazing, but it's not true, no different than you buy a condo outright for $500,000. You go to CIBC, you get a line of credit for, let's say, $375,000, 65%. You take that line of credit and you get a line of credit with CIBC, and then you give them the money and you buy stock of CIBC.
Right.
No one would say, well, I'm doing this to recapture the interest payments because now I own CIBC. So now I'm making the interest payments, whereas before I wasn't. And like two things can be true at the same time. A, that may not be a bad investment because the dividend's going to take care of a lot of your interest payments. You get to write off the interest. You're going to get the capital appreciation of the stock. So it may actually be a good investment, but the idea that you're making what CIBC makes, it's just not. The dividend is lower than the debt rate that you're paying on the debt.
Well, does the money care? Like what the interest rate differential is or who gets that?
The money doesn't care, but you should if you're sold it. You know, like if an advisor came to you that's saying, oh, your house is paid off, right? Borrow $500,000 against your house with CIBC, then put the money into CIBC, and therefore you don't have to worry about the interest payments.
Yeah.
You would immediately say, no, I do have to worry about the interest payments. Like no one would buy that product, right?
Exactly.
But also no one's paid to sell that product. And that's the irony. Yes. And that's why these are so popular. So 2 reasons why they're so popular. First is because it is the most incentivized product in all of financial services, bar none. All other financial services that are considered an investment, you either pay like a fee for it up front, with private stock placement.
When you say incentivize, you mean for the advisors to sell
100%.
or for people like customers to get?
No, I mean from the advisors to sell. Okay. You know, so if you put $100,000, if you go to your advisor and say, hey, you know what, the market's down, I want to throw $100,000 into the S&P, they'll make a trail of, let's say, 1%. You know, so if they're lucky, they'll make $100 a month off of that, or $1,000 in their first year. But if you go to someone and say, oh, you have $100,000 a year of retained earnings, I have a wonderful estate optimization tool that's great for estate planning purposes. It's going to grow tax-free. You're going to get 6% on your money. It's all going to be paid out tax-free to your heirs that you can borrow against as it grows. $100,000 a year, then that advisor can make, like at my commission scale, if it's all base premium, I'd make $150,000 upfront. Like that's a massive delta. You can't tell me that incentive doesn't matter significantly. And then the second thing is you're told that you're making 6% on your money. So I had an argument with an advisor on this, and he said to me, why would I take all the risk of the stock market if I could end up at the same destination? And I'm like, that's totally true, right? But it's just, you're not at the same destination. Like you're just not. So if it was true that buying this life insurance policy means I would get market level returns without having to deal with all the hills and valleys, then I think it'd be a wonderful product. But the problem is that's not what happens. The dividend scale interest rate is not a rate of return. So if I sell you an investment and I said, you're going to make 6% this year. If you put in $100,000, you expect to make $6,000.
Yep.
However, if you put $100,000 into this par policy and the dividend scale interest rate is 6%, you're not getting $6,000. It's just not true. Now, I don't know what you're getting because you had a policy. If you look at your statement, it doesn't tell you how many units you had. It doesn't tell you what, you can find out what the performance of the fund was, but that doesn't necessarily mean that's what you're getting. And they call it a dividend scale interest rate. They don't call it a dividend. It's not like they're saying, oh, you have 100 shares, we're issuing a dividend of $1 per share. Here's $100. They're intentionally misrepresenting it and calling it a return to make you think you're getting a lot more than you are. When you look at these illustrations and you illustrate the internal rate of return of these policies to the age of 100, at the latter years, you're looking at anywhere between a 1 and depending on the company, a 4% internal rate of return. So it's basically like a bond fund over your lifetime. But it's not sold as a bond fund over your lifetime. In fact, if you tried to sell most people a bond fund over their lifetime, they would probably say no, right? Or they're like, I have $100,000 a year. If I'm going to invest in a bond fund, I'll put $20,000 a year into the bond fund, but I want to go to the market for the rest. And that's the problem. You have incentives and you have misrepresentation, and that's driving the market, not the fundamentals and not the numbers. And not enough people, I think, are talking about it. And I realized in my early stages of kind of pounding the pavement on this, I was attacking the rhetoric. And the problem is that the rhetoric of the infinite bankers or the people peddling these policies is much stronger than mine because people want to believe in something. And like, I get that. Especially, they tell a really good story of like the institutions aren't on your side. Like, I don't know how people automatically think the insurance companies are like, but I get that. It's like, oh, they're not in control. You need to be in control. They're not there for you. Like, this is there for you. They're not doing right by you. These people are doing right by you. It's an us against them type of play. David versus Goliath. Like, you can win and this is how you win. But And I can't.
And your rhetoric is like
Like,
they're not doing it, and they're
nobody's
not doing it, and no
right?
one's doing it.
Yeah,
and you're
exactly.
left-
No one wants to hear that, right? And then I realized, and then that's when
That doesn't seem to resonate.
Yeah, no, it doesn't. And then that's when I realized during hearing, Jason speak about his own policies, and when he mentioned how he's making all this money in dividends every year, and I was like, oh, I think that's the answer. I think I need to approach this from a more like number standpoint. And I've had a lot more success since then, because a lot of times I've had meetings with people and they'd be like, okay, it's a scam, so what should I do? And I'd be like,
Not this.
yeah, exactly. And I didn't have a better answer for them. Now I have a very good answer. Now I'm telling people exactly what to do. And what I'm telling people to do is exactly what you were going to do with the life insurance policy, but just buy the index and mimic it.
Right.
So,
But that's assuming that someone has the capacity in the first place to do what they were going to do with the insurance policy, right?
exactly. Now, it's what's interesting, I've met a bunch of people who are mimicking exactly what they were doing with the insurance policy with the index. So there was a guy I met, real estate professional. He bought this policy to dump $1 million into it over the course of a few years. And the idea was going to grow. And he has a line of credit out on it to do mortgages on. A lending facility, because he does a lot of second mortgages.
Yeah.
Very smart. And then I sat down with him, I'm like, okay, here's your insurance illustration. Here's how big your line of credit will be over the next 10, 20, 30, 40, 50 years. Or you can take that same money, buy the index. Here's how big your line of credit's going to be with the same institution that's lending you money against the insurance policy, Duca Financial, over the next 10, 20, 30, or 40 years. And you're just like, it's a no-brainer. Like, I have so much more access to capital, and it's going to grow 3 times as fast through the index, and I'm going to pay a fraction amount of in fees, and I still have the ability to do second mortgages. I'm just going to cancel the life insurance policy, buy the index. And then he's like, oh, crap, what happens? Sorry, I shouldn't. What happens if I die? Okay, you get a 10 or 20-year life insurance policy because you're into debt, cover the debt, and then after that, you're fine. Or you get a small permanent policy to act as some liquidity. But the idea that over the long run, the insurance policy was best for taxes or growth or leverage, it just wasn't true. And the numbers bore it out.
So, okay, so there's the question, right? Everybody's afraid of that boogeyman, taxes. Mm-hmm. And one of the big things with infinite banking is that you have this policy, and then you are able to take out money or whatever, get a line of credit equal to the amount of whatever
cash value
dividends in there, tax free. And isn't that a much smarter way to handle your money, right? Work with tax free money.
Totally. My point is that you can do that with the index as well. Like your principal residence or your real estate properties, as they grow in value and as the debt's paid down, you can refinance and you take that money back and you don't pay tax on that, right? It's tax free. You put $100,000 a year into the index, you can borrow up to 75% of that tax free. You're not disposing of your interest in the index. It's still growing. You take that 75% out, you're not paying tax on that. So I'm not saying that there isn't merit to the idea of tax-free growth.
Yeah.
I'm just saying that that's a number. That's not a feeling. Like taxes aren't how you feel. Taxes are like a dollar amount you pay. And just make sure that you're actually ahead based on the dollars and not just feel like you will be ahead. I speak to a lot of people inside the insurance companies, and I asked one of the wholesalers of the companies, I'm like, who buys this stuff? Like, who? Like, I see all these advisors submitting these massive cases. Like, who is buying this? And he said, super high net worth individuals take the bond component of their portfolio and stick it into the product. And I get that. Because let's say you're wealthy, you're old, and you have a $50 million portfolio, let's say, which a lot of people do. That's a lot of money, but there are those investors. And you're invested in all bonds, right? Because you don't want to take any risk, or you inherited a lot of the money, or you don't need that much. Your portfolio is spitting out $2.5 million a year. Fine, you spend half in tax, but you're spending $300K a year. Like it's way too much money. So what you do is you take, let's say, 10 to 20% of that, and you dump it into the participating policy. You're going to get those same bond returns, but you're not going to pay the tax. As it grows, you have access to the capital via a lending facility, which you could have done in a non-registered manner. If you die in the short term, there's extra money for your family because they need more than $50 million. But in the long run, you're effectively getting that same coupon, but saving 50 cents on the dollar and you're not paying tax.
So compared to bonds, it ain't bad.
Yeah, I'd say it's like if you have if you're super high net worth and you have a large portfolio in bonds, like I get it.
Yeah,
I get why someone like that would buy it.
But at that point, it's more about preservation of capital than
well,
being your own bank or increasing your capital.
It's
right?
technicals, right? But at the same time, preserving it based on whose metric? Do the people who invest in these things actually think inflation is 2.5%?
Right.
Because if I had $50 million, I still wouldn't be buying bonds. I would still do exactly what I'm doing right now. I would buy the index, right? I wouldn't buy Fartcoin, right? Much to your son's chagrin, I guess.
Well, we'll see who's right in the long run, Adam.
If I come back next year and next thing you know, Fartcoin's the new Ethereum, I'd be like, damn it, I missed the boat on that one. But and that's at the end of the day, if you have so much money and the money that you're making is more than enough that you need to live on and your portfolio is still growing, then I'm really not speaking to you. Right. You're not my target audience. You did it. I can't sell to you. I can't talk to you. I don't feel your problems. When I work with people and I deal with people, I need to be able to relate and feel their problems. If someone comes to me and is like, oh, I have this $20 million portfolio, I'm trying to optimize my taxes. I'm just like, I don't, that's amazing, right? If you made it yourself, tell me how, if there's any cool investments, tell me where. But if you're just looking for don't get me wrong, I would try to show them this type of product, but I wouldn't be emotionally in it in the same way I am when I met you. I want to see something and feel like I'm actually solving a problem for someone. And it's hard for me to relate to those people with that high net worth because I just don't know, because I can't relate. I don't have that type of net worth. I'd love to get there one day. But the irony is you don't get there through being a bond investor. You don't get there through
being these types of taking risk.
Exactly. You have to take risk, you know? Exactly. Yeah. And the irony is, if Fartcoin becomes huge, that's his story, right? He makes $50 million and he puts, listen, how about this? If your son makes that much off Fartcoin, can he buy a $5 million par policy from me? Can we make that deal? Okay.
He doesn't have any, by the way. Okay. He was interested. I'm like, no, cool. We're not doing that. So Adam, maybe you're changing my mind. Yeah. But I will send him your way.
Okay, perfect. Thank you. We'll shake on it. We'll get it on camera. Okay.
So to all the other 100% of our listeners who aren't that demographic.
Well, and I think last time we talked, that was the thing that got you a little bit riled up. Is you're talking average Joes, who are they're working. They got to work in order to eat, and they have some extra, right, to invest and stuff. So that's great. But now they're buying this. They're being told this is the way to go, right?
Yeah.
This is what's going to do it for you. So,
it's not necessarily that it'll do it for you, but this is a great base to help you do it. And it's a conservative base because of the taxes, because of the access to capital, because of the life insurance, because if something happens to you.
Yeah.
But just the numbers don't make sense. I was flipping through this and I saw an illustration here. Where was it? Here, I think it was $40,000 a year for, 4 years of an outlay. And start year one, age 30 to age 84. And the death benefit of $3.1 million.
So that's $40,000 a year?
$40,000 a year for 4 years and $18,000 for 3 years. It's a complicated deposit schedule. But what I'm saying is that if you mimic this deposit schedule with the index, when this is worth 3.1 million, the index is going to be worth 40.
40 million.
40, yeah. These are the numbers that I'm talking about. For people in the 30s and 40s, right? Whatever you're putting into these things, you're leaving 5 to 10 times that on the table at the age of around 90 to 95. That's not insignificant.
And that's just the index.
Just
there's
the index.
Other things you could do
with
your money. Yeah.
Yeah, totally. I think the reason why I use the index is because I think it's the best benchmark.
Yeah.
You're betting on you're betting on United States, you're betting on the biggest 500 companies in the world. If one of them drops out, another one comes in. Like in the long run, as long as the economy maintains status quo within reason, you're not going to lose money. It may suck for a few months at a time, or even for a few years at a time, but you're not going to lose money. I'm working with someone who I'm trying to get her to get rid of her policy because I just don't think it makes sense. And I actually spoke with her advisor about it. And
how'd that conversation go?
Yeah, it was. I like talking to people, right? And he basically said, well, the reason why what you're doing doesn't make sense is because like I plugged in 6%. And I'm like, well, that's the first thing I disagree with. If you plug in that low of a return, of course, something like this would look good. And this is not the person who sold her the policy, by the way, just the person who's helping her with the finances. But
did the person not want to talk to you? The one who sold her the policy?
No, he did. He's a nice guy. Like we're friendly. We have lunch here and there. But I lost my.
He plugged in 6% as the rate of return for the index.
No, for the policy. Like,
right.
Sorry, at the rate of return of her investments. I'm like,
right.
well, that's the first problem. If you're plugging in 6%, like it doesn't make sense. But you should just plug in more. You know, like if you are invested in the index properly, you're going to make 10%. So when you tell someone, oh, someone should keep a policy because our goal is 6%, and this is going to look like it's going to be a good thing for your portfolio because it's going to do similar to what your investments are doing without the same risk. I'm like, well, yeah, but like, just take more risk then. Like, you're better off taking these premiums and taking more risk and buying term insurance to offset it rather than being conservatively invested in something like this, or even conservatively invested in your existing portfolio.
What are the insurance companies investing this money in these
bonds,
participating
real
policies?
estates, some stocks, some private mortgages. It's a lot of bonds. It's a fixed income portfolio is what it is.
Yeah.
Discretionary, but it's a little bit of real estate, a little bit of stock, a lot of bonds. Yeah.
Okay.
You know the Manulife building downtown?
Yes.
You know, that's in, I think, as far as I know, that's in Manulife's par portfolio. Like they own a lot of real estate.
Oh, really? They're
Yeah.
their own building.
Mm-hmm.
They are their own banker.
There you go.
They're their own investor.
But what's interesting is that like the returns of the returns that you're getting in your policy is based on the accuracy of like predictions.
Yes.
And this is what I think we discussed a little bit. A lot of people don't realize that. They think they're getting the function of what the fund is doing, but it's a predictive mechanism. And I started down this path because I started meeting all these people who had these policies from years ago that were now worth a fraction of what they were supposed to be worth.
Right.
The sad reality is, though, when I get a call from a client who's in his 60s, you know, whose dad passed away, who's in his 90s, he doesn't say to me, oh, Adam, can you pull up the illustration from 1973? What was this supposed to be worth? What is it worth now? What was that based on? No, like someone just passed away. You probably do have some money because if you bought anything in the 70s, you're ahead today. And like the truth just dies with the person that bought the policy. Not to mention the advisor's like long gone.
Yeah.
Policy's been on the books for ages. But as I get these claims, like I ask the insurance companies for these illustrations, and sometimes you can't get them. Sometimes they're in my files that I scanned in when I took over these old books. And generally speaking, the values are way off. And I'm just like, the more and more I saw these, more and more I was like, why does anyone buy these? People are like, oh, liquidity. I'm like, well, the index is liquid.
Yeah.
You know, over taxes. I'm like, well, if the idea is to be ahead, you know, pay the tax and you'll have more money. So every time someone says to me, well, these are all the reasons you should buy these products, I'm just like, well, like, I just don't think those reasons are good. And how you feel about something is irrelevant. It's what the numbers look like.
Yeah, so that's kind of what I was saying earlier, right? Like, does the money care? Like, the money doesn't
Money
care.
doesn't care, but you should, right? Because if you want more money, right?
But that's what I mean. Money
Yeah.
doesn't care what you feel.
Exactly, you're right.
It's going to get the return
That it
however you
deserves
put it to
based on
work.
what, exactly.
So despite all the rhetoric on both sides of the argument, like what it comes down to is show me the money, right? Show me and yeah, I know you can't predict, is the stock market going to crash next year? Maybe it
Probably.
will. And maybe, I mean, probably. I mean, this
As
is why
soon as you put money in,
yes,
it will crash.
usually what happens.
Exactly.
I'm a very good predictor of stock values. No, but I mean, essentially, you're going to do parallel illustrations. I'm assuming that's what you're doing, right?
That's what I'm doing,
people.
but no one else does. Like when people are sold these participating life insurance illustrations, the person selling it to them will be like, this is, if you do this with the money, this is where it could be.
Right.
The problem is when they do those comparisons, they compare it to like the traditional 60-40 portfolio, or, oh, why make 5% in your money here after tax when you could make over your lifetime 5% of your money here, but being tax free. Like they take you down a path that allows you that ends up with selling the policy. Like it's not right. It really isn't. Now it's hard for people to know it's right because everyone has an opinion. Everyone's in a different financial position. But I can't reconcile the fact that everyone I meet, and whenever they tell me how much they bought or how much they're being pitched, I look at their financial situation and I'm just like, you should not do that with your money. Like if all you have a house with a big mortgage, you have some RSPs, some TFSAs, you have a couple of kids, fine, you have some term insurance, and left over you have $1,000 a month, right? And you're putting $1,000 a month into this. Like it doesn't make any sense to me. Like you're not doing right by your money. Oh, but what if there's an opportunity I want to take advantage of? Okay, build it up in the index and take out a line of credit on it, right?
Yeah.
Oh, but what if something happens to me? Well, we'll buy some life insurance. But you can't, all you're doing is by getting something like this, you're just sacrificing opportunity. And when I go through my insurance presentation with people, that's effectively my pitch. Term insurance is guaranteed money down the drain. Permanent insurance is guaranteed opportunity down the drain. Like pick your poison. There's no perfect outcome. There's only trade-offs in life. You know this. Like you work really hard, you gain the benefit of it, but like it's hard to work hard. It takes a lot of time. There's no guarantee you're going to win. You could have an easy life and not work hard, but in the long run, like the trade-off is probably won't have a lot of money.
Mark, what did one of your tenants say? I'm not a working person.
What did he say? What was it?
Oh yeah, that's one of the tenants. I don't know. She's having trouble paying rent, and she's talking to my wife, and she's like, "Oh, but I'm not a working one of those working people."
So
right?
does she pay
rent? I don't think she's ever worked. Well, government benefits, right? And complaining about this and that, and I think my wife's. I don't know what the context was, but I think it was because we were trying to have some work done at the property at like 9 a.m. And she was like, "Oh, that's so early." And my wife's like, "It's kind of it's a normal time. It's
I think
actually late." And she's like, "Well, I'm not one of those working people." I'm like, "Oh, yeah, one of those." Like,
yeah.
Oh man,
It's a different reality.
Yeah, exactly.
So many years ago, I held a life insurance license.
Thanks for I thought you were just going to say for policy, and I was going to make a sarcastic comment. Appreciate the business,
Yeah. No, and also mutual funds license. And,
nice.
That was our the theme with this company was like buy term and invest the rest.
Was it Primerica?
Yeah. So I'm not a sales guy. I was not cut out for that at all. But like that always kind of stuck with me. And so
I hated that advice early on.
What's that?
I thought that was the propaganda.
Oh,
right?
yeah.
Yeah, I was just like, these guys are like peddling, this silly and compelling people not to get permanent insurance, but it's important to have permanent insurance. And yeah, that's a really good pitch too,
Yeah.
It was.
Yeah, but I didn't 100% understand. Like I kind of got it with, universal life or whole life, right? And it's like, hey, you're going to pay for your whole life.
Yeah, exactly.
One of the jokes.
The thing about that, my pitch for buy term and invest the difference is not you should buy term invest the difference, but what are the implications of your cash flow? Like I'm not telling you what to do with your money. I'm just telling you that this is what the different piles look like in 40 years and choose wisely. The Primerica pitch was interesting because they didn't tell you to buy term invest the difference here. They said buy term invest the difference here.
Yeah.
The idea was for them to gain assets under management. There's a lot of people that I meet who have bought reasonably big policies in a few $1,000s a month They'd have a lot of equity in their house and it's almost paid off. And I'll say, you're paying $1,000 a month. Or say the one I'm working with right now, I think they're paying $25,000 a year, okay, in premiums to a par joint lasted par policy. House is almost paid off. $25,000 a year divided by 5%. How much interest does that serve? That's probably $1 million. Can you run the math quickly?
On what? Sorry.
25,000 divided by 0.05.
Yeah. So if
is it, no, $500,000, right? What is it?
What is it?
25,000.
Yeah.
Yep.
Divided by 0.05. Yeah.
Yeah.
$500,000, right?
Yeah.
So what I said to them, rather than pay $25,000 a year in after-tax premiums, your house is almost paid off. Take $500,000 off your line of credit. Pay $25,000 a year to service that debt. You're both in the 50% tax bracket. You'll get 50% back every year on your taxes because it's like an RSP. So your net debt servicing is only $12,500 a year. And you take that $500,000 and dump it into the index. And in the long run, it's not even funny how far ahead you will be relative to the life insurance policy. And do it in Questrade because you're going to pay 0.001 in management fees. And then they're like, well, how do you make money? I'm like, buy a $500,000 life insurance policy from me for $100 a month. And if you die within the next 10 years, the debt's wiped. Or even 20 years, buy a 20-year policy. And after that, the portfolio is going to be worth so much more than the debt, you're good to go.
You don't need the insurance.
You don't need the insurance again. Or fine, get a $200,000 permanent policy just to have some liquid. I'm not saying don't buy any permanent insurance at all. I'm just saying too often we look at these illustrations without asking ourselves, can we mimic what I'm being told without the life insurance? Can I accomplish the idea of being my own bank with a superior asset? Can I borrow and leverage with a superior asset like my house or a stock portfolio? Yeah. That's my only point. And in this case, it's a nice little deal for me. These people are going to be doing this. I'm going to be selling them a little bit of a policy. They're going to be canceling $25,000 a year in premium that advisor would have made probably $35,000 on, and I'm going to make $2,000 on a term insurance policy, which is still I think a nice sale for me. I think I'll do those all day. But then they tell their friends, and it's a different story. It's a much better story, And rather than going crazy to try to sell 3 or 4 of these $35K policies a year that you're pushing to get across the finish line, that people are looking at those numbers. You looked at it, you were just it took you some time to be willing to write that check. And even after you wrote it, you're just I don't know why I'm doing this, but everybody is doing it. But at least with this strategy, it's a no-brainer and the numbers make sense. And they really do make sense. It's just hard for people to do it because everyone knows the second they put the money into the index, it crashes. That's the hard part. It's hard to pull the trigger on that stuff.
It is, but yeah, the one thing that you mentioned right off the top was incentives, right? And so whenever you're dealing with somebody trying to sell you something, you got to look at incentives.
Yeah, you
and
have
be
to.
like cui bono.
Keep on, yeah. There you go. Good one. Thank you.
Sorry, that's one of his other companies, folks. Cui bono, and that's the benefits.
The benefits one, yeah.
Benefits side. Anyways, it's Latin for who benefits.
Exactly.
And ask yourself, what's the incentive for this person? Because a lot of people sit down with the insurance advisor that has dealt with their family, their grandparents, their uncles, whatever, and you just assume they know what they're doing. They have your best interest at heart. And I'm not saying everybody who's selling insurance is doesn't.
No, I think everyone does.
But
this is why it's so hard because most of the people who sell the immediate financing arrangements, which is technical term of infinite banking, just the idea of buying something and taking on the debt immediately. They genuinely believe that they're doing the right thing for people.
Yeah.
I think they're wrong. I think that they've let the industry and the messaging that the insurance companies provide get to their head. But they believe they're doing the right thing. And that's the hardest part, because there's very few actual bad actors out there. People trying to steal from you. It's the minority. The highway to hell is paved with good intentions, I believe.
Yeah.
There's no nefarious people. They're not trying to sneak around and lie to you to sell you a policy. They're working with your accountant. They're working with your financial planner. They're trying to put something together that looks appetizing on the surface and saves you on tax and they're getting everybody on board. It's a lot of work. I just think it's all fluff. And I genuinely believe that all you're doing is replacing the tax man with the insurance man. Like there's no, like, fine, you may be saving on all this tax, but who's benefiting from all the tax that you're saving on? Like the insurance companies. And now they're investing that money and giving you a fraction of it over the long run. But when a client passes away and the family gets a check, they confuse the death benefit with the strategy working.
Right.
So you're like, oh, well, my dad passed away, my mom or my wife passed away, and I got this check, and like it did what it was supposed to do. And then it feeds the beast, and people keep buying into it, not realizing that one has nothing to do with the other. Like the insurance piece is an insurance piece, but has nothing to do with the strategy that was implemented. And you could probably do better with the strategy that was being implemented, or much better, you know?
Yeah, so at the end of the day, you need to just sit down and do a comparison, and that should tell you, that'll tell the story.
Totally. Right. And also be willing to take risk. That's, I think, the big thing. I think too often people in my industry try to scare people away from the stuff that they should be embracing. And it's taken me a long time to do that. I think kind of like money is kind of like exercising. Like there's going to be a long period of time that you will be uncomfortable with it, and you have to get comfortable with that uncomfortable. I can't remember when it was, but I think it was a video with Warren Buffett.
Is it the time where you lose all the money and you're uncomfortable for a bit?
Yeah, totally. But I think it was Warren Buffett who said, like, when something goes on, if you were at your favorite store and something went on sale, you'd want to buy more of it. Like, and that's the way you should approach investing. If you really believe in something or think it's valuable and it goes down, like that should make you happy. It shouldn't make you sad. You should view this as an opportunity. And I think too often people are so worried about the risks, the volatility of the market. And rather than an advisor tell them like, no, it's all part of the plan, volatility doesn't mean you're going to lose everything. There's a difference between stock picking and buying the 500 largest companies in the world. You're only 35. You can deal with it. In fact, get used to it because it's going to happen 10, 20, 30 times or more over your lifetime. You owe it to yourself to take this risk rather than being like, oh, it's too risky. You know, you won't, it's too complicated. It's going to be hard for you to sleep at night. It's so stressful. Like, I don't think that serves people well. I don't think that's good advice.
It almost sounds like a bit of a pitch for Bitcoin, eh, Brett?
I love Bitcoin. I think it's
so
like
listen,
the best.
whatever Adam tells you to do, folks, do that, but then take like 10% of that money and put it in Bitcoin.
Do you know how many people I speak to who will say to me during my calls, they're just like, I want to buy Bitcoin. Like they're looking at these premiums and they're just like, why aren't I buying Bitcoin? I'd be like, why aren't you buying Bitcoin?
And what do they say to that?
Most of them, when they cancel their policies, they put cash flow into Bitcoin. I would say the vast majority of them.
Oh, really?
Yeah.
Okay.
I think it's two reasons. A, because like the circles that I'm in are like people who are thinking a little bit differently about the financial services and money. But also it's just becoming more, it's on people's radar now.
Yeah.
You know, it's being normalized. Institutions are holding it. Governments are holding it. People are starting to understand this fiat stuff, you know, and how it's basically paper backed by belief. And I guess Bitcoin is, you know, digital paper backed by belief, but it's fundamentally different.
Yeah, it seems to go back to what you just said about risk. Like if the fiat system is just based on belief, like the whole reason you have to take risk to begin with, like it sounds like you strongly believe we should be taking risks with our money.
Like you have to, no choice.
So, but why do you have no choice? That's what I want to get to is like, why do you think we have no choice but to take risks? Because like in eras gone by, was it the same way where you could just work hard, you get some savings, you go out the next day, you work hard again, you get some savings, and you turn around when you're 90 and the savings are there, right? Like, or is it the fact that everybody's got to always take everything of their savings, take that risk, and the more risk, like, I mean, obviously calculated risk, but the better.
Yeah, I think you need to decide what you want in life. Like if you're that high value and you make that much money and it doesn't even make sense for you to pay attention to this stuff, then don't. You know, like I doubt who's that guy in Minnesota, Kaprizov, who just signed that like $17 million a year deal, right? Like he's not comparing the index to like a bond, like it doesn't, he's probably going to put most of his money in a 60-40 portfolio, like, and forget about it. Because once you pool $200 million, like who really cares at that point? Most people don't have that luxury, and that's why they have to take risk. Because most people are never going to make so much money that they're able to take a meaningful amount of what they're making to set it aside. It's easier said than done to be extremely frugal. Like you want to buy a house, or even rent's expensive, even if you don't buy a house. Food on the table, kids, extracurriculars, life. You want to live now as well. Like there's a lot of people talk about the fact, well, like who knows how much time I have on this earth? Like what am I saving for? Like that's a legitimate consideration. And because of that, and because of how hard it is to make money and how quickly it's being devalued, you owe it to yourself to try to take outsized bets. It's hard to take outside bets, and you're going to lose. But if you can get better at it over time, I think you would surprise yourself. I didn't start out in finance. Like I did kinesiology. Like I wanted to go to med school, and then when that failed, I kind of maybe wanted to go to law school. I didn't. I kind of fell backwards into this industry. And early on, I thought I was really smart. I did well. And then I realized I just got lucky. And then slowly over time, I've gotten a feel for the type of risks that I want to take and learn about them. And if, like anything, if you focus on something long enough, like you will get better at it. Whether that's swing trading, day trading, selling something, renting out properties, mortgages. Like there is something you can do with your money, with some learning, that you will allow you over time to make outsized returns relative to the market. Like there is for everybody. Will it take time? Yeah. Will it be painful? Yeah. But it's definitely going to be worth it.
Yeah. I just feel like that the reason why that is a necessity is because the money that we have, it doesn't stay stable. It loses value, right?
Totally.
Like the default position for everybody now is they're going backwards.
Yes.
Right. Like if you work and do all these things and do all the extracurriculars you're talking about, and then you have a little bit left over, let's say, and you just keep it, you're going backwards as of tomorrow, right? Like the next day, and then you fast forward 40 years, or like the time frame you're talking with some of these policies, like
easy, isn't it? To think about?
The amount of that compounds over, like you just go way backwards. So I feel like, it's frustrating that is a reality.
It is,
I guess. And just like acknowledge that, like the risk shouldn't be like, you shouldn't have to take the risk.
You shouldn't have to,
but
no.
You do.
But also back in the day, I felt like when life was simpler, you could be like, well, like I have my own farm, like I could eat, like I don't need like fiat dollars. If I have them, great. But
well, because part of that is greed.
Yeah.
Right.
100%.
Like even these people you're talking about earlier who have $20 million and blah, blah, blah. They might not still be satisfied with that. Right.
No.
Like they might always be pursuing more.
Yeah.
And more and more and more. Right.
Yeah, totally. It's a guy that I'm working with right now, who's I think 3 or 4 years into his policy, a similar situation to a lot of people, mid 40s, $1 million place, $500,000 mortgage, both spouses make more than $100K a year, one kid, enough to get by, enough to have a little bit of TFSAs and RSPs, but like, what am I doing in the long run? Like having just a paid off house, like is not going to cut it when I'm 65 and I'm putting $1,000 a month into this. I have a small TFSA. Like, what do I need to do? I totally understand. Like for those people, I think you owe it to yourself to have a position in Bitcoin. Like you owe it to yourself based on how valuable this thing could be in 20 years. The risk is worth it, I think. If it 100x, whatever it's going to be, if it goes to zero, don't have so much that it's your life savings. I don't think that's going to be the case personally, but given the potential of this asset class, you owe it to yourself to have a sizable position in it, because if it becomes anywhere close to what all these smart people say it could be, that's your life. That could be your retirement. That could be your financial freedom. And considering you don't need that much for it to be meaningful. You really don't. At least I think so. You know?
Yeah.
I think so. You guys probably do as well.
This is not financial advice.
No,
we went from Ethereum to a whole bunch of other coins. Back to Bitcoin. I don't know.
And it's so funny. Like, I don't know. I watch a lot of guys online, and it's like, this is not financial advice, and here is the financial advice. It's just everyone's trying to cover their butt.
Yeah.
You know, everyone is.
Yeah.
And the irony is that
We need insurance.
yeah. No, and the irony is that the people who are licensed to sell this stuff, like, they are providing financial advice, right? And they say they're providing financial advice. And the irony is, you can argue that the basis of that advice is broken. Of course, it's okay to make 5-6% a year if inflation's 2.5%.
Yeah.
Why take the risk if your money's only being devalued at 2.5%? But what if that's all wrong?
Yeah. And
So the advice is all, and that's the irony. The people who are giving financial advice, it's bad advice.
Yeah,
and the
it
people who
sounds
say
like-
they're not giving financial advice are probably actually giving you, assuming it's not Farcoin, are probably actually giving you the better advice, you know?
It sounds like we need more regulation to prohibit these people from selling these things.
Oh, Brent.
We need to layer on regulations, Mark.
Yes.
Oh, man.
That's always the answer. More regulation.
More government, bigger government.
I don't think that's ever gonna. That's even a bigger problem, you know.
Yeah.
Even a
That's
bigger
another
problem
one.
because I don't think they're doing a good job either. You know, there's no incentive. The incentive model there is broken as well. You
Yeah,
know?
this podcast is all about revealing the problems, not the solutions.
Yes.
Just the problems.
Solutions are hard. Problems are easy.
Yeah.
I'm involved in this investment, and it was just a small fund. I put a few $1,000 into, and this guy was like forex trading, and he was supposed to promise like 5% a month, not promise, and he had his accounts frozen by the BC Securities Commission, and he's getting investigated. And I think my money's gone, and a group of us hired a lawyer to try to push the Securities Commission to disclose to us, because this has been going on for 2.5 years.
Right.
And I've been emailing the Securities Commission. They're like, listen, like, his interview was back in January. This has been going on 3 years. Like, is our money gone or isn't it gone? Because if our money's gone, let us know, right? So we can like approach this as a group. But if it's not gone, then let us know. And you can do your thing. So I spoke to like a lawyer, and the lawyer's like, they technically have 6 years and they don't have to tell you anything.
Wow.
And I'm just like, but they're the regulators. And I've been I was like, there was a lot of like angry emails to the regulator, just like, please tell me, just please tell me. And now I'm just sending the guy like sarcastic emails. You know, I made a joke about like, you know, in the movie Interstellar, when they go, I don't know what planet it is, but they go to that water planet. They come back and he's like 16 years older. So my last email to the guy, like, I made a joke that I feel like I'm that guy. I'm just waiting for 16 years. But what's crazy is that like these are the people that are supposed to like make sure that everything's okay.
Yeah.
And it's okay if it's not okay. Like, if it's not okay, you shut them down, then you're doing the right thing, right? But like, is there money there or not? Like, it's a simple yes or no question. Well, we froze the account. How much is in there? Well, like just tell me, you know? And it's just, I'm really disillusioned with a lot of things because I just feel like there's a lot in this world that's broken, and like half the battle is like everyone acknowledging how broken things are. And you're saying we don't talk about solutions, we talk about problems. But I think the big problems people don't talk enough about. Like, they really don't. Like, most people, I don't know if you bring up at your dinner parties or with friends, you bring up Bitcoin, people still roll their eyes.
I don't get invited to dinner parties anymore.
I have a buddy of mine, I have this discussion with him all the time where we talk about like fiat currency. I think that's broken, the money supply is broken. And like, he'll roll his eyes, be like, oh, here we go, into Bitcoin again. I'm like, it's not about Bitcoin, right? Like, call it whatever you want to call it. But the idea that the people in power should be able to devalue your time just by issuing paper that you spend time earning money for, like, that's not good. And you need something better to replace it. You don't think it's Bitcoin? That's fine. But like, I don't know if it's Bitcoin. I just know that like a lot of smart people agree that it's doing the job right now. And if there's something better, please let me know, because I'd like to get in early on it. But not enough people actually believe that it's a problem.
No, 100%. I mean, you could replace Bitcoin with gold bugs, right? People
Yeah.
who are into gold.
Totally.
It's all the same arguments. like which we agree with, right? Like, and what you're saying, there's a problem. The whole system is broken. What's the solution to that? I mean, there's differing answers. But it's acknowledging you have a problem is the first step.
Yeah.
In so many things.
You reminded me of something. So that guy that I invest in with his fund, he doesn't touch any crypto. In fact, I just sent him a video on the Bitmine immersion stock, Tom Lee's Ethereum treasury play.
Okay.
And because I respect him so much as an investor and as a smart person, I'm like, please research Ethereum for me because I'm interested to hear your thoughts. Not to mention, this is an interesting play on Ethereum, levered play on Ethereum. And I had a discussion with him a while ago, about Bitcoin and what do you think of the fiat system, the money printing, how this stuff works in the context of your overall investments? Because you're building a fund here that has a lot of people's money and all this money is in fiat or based on the fiat system.
Yeah.
And his opinion was they're businesses that provide value. I don't care what they transact in. I'll let you guys figure that out. Or not me guys, but you know what I'm trying to say? If the government says it's a CBDC or if they're going to transact in Bitcoin, Ethereum, or Farcoin keeps coming back, whatever they transact in, they transact in. But this company does the best job of selling milk and people always need milk. And whatever unit they buy milk in, this company will make a spread on that. Right. And this company, and it was a really interesting take. And he just doesn't care, which is kind of weirdly cool and comforting in a way, because I feel like too often I consume myself in circles that are the system's going down, and your leg up is Bitcoin, and you're just like, oh man, is it? What does happen if it goes down? What are things going to look like?
Yeah.
Meanwhile, the big investors of the world are like, I don't care. People will figure out how to transact. I want to buy companies that are doing great things, independent of what they transact in.
Someone producing value.
Yeah, 100%.
Right? Produce value, and then the value should always be there.
But that's the two options, right? Back to what I was saying before. The one is you hold your money and it maintains its value, and there's should be little to no risk, right? And that's the default position that the average person should be in a position where they earn the money, they provide value to society and they earn the money, and they hold it in some vehicle that does not require.
Well, why is that? Why does that need to exist? Should an object that isn't growing or isn't moving retain its value over time?
Well, because it was traded for value that initially, right? So I went to work, I worked, and that value is now transitioned from my time and labor into a medium.
Yes.
And that medium is right now being debased at a rate of
8%,
maybe they say 2.5%.
It's not
8%, whatever the percent is. They are taking the value of my labor in the past and they're spending it now.
Yeah.
Right? Without my permission, and now I'm left in the future. Yeah. So, right. Everybody's having this, and maybe there's not as much outrage because people don't feel the value of their time stolen.
Well, I think there is a lot of outrage.
But I think
you're seeing it in society.
That's justice, right? Justice is, I worked for this, it should maintain its value. Now, if you want to take risk,
why should it maintain its value?
Because does your labor have value?
No, less and less. I think my labor has less as technology.
But if it has less and less, then your wage should go down, right? But if you actually
wages are going down.
Yeah. So if wages go down, but they just increase the minimum wage or whatever,
yeah, totally.
So if wages go down, that's great. Now we can produce the same amount of stuff, more valuable stuff for less, but they push it up, right? So the value of your time has a value. If let's say, one guy produces a ton of value to the economy. Well, he should be compensated accordingly, right? Great. Yeah. Because we need more people like that to produce more value to the economy.
Yeah.
Right. But for the average person, when they're stolen from, right? That should be the default
I guess
position.
I was thinking in longer time frames.
And so a guy like this who's investing money in companies that produce value, that's great. But that also should be I chose to take a risk with my money, and I want to put it in a spot where it's going to produce more value or whatever, right? So, but the default position shouldn't be you're going backwards. It should be you're staying here. And if you want to do more risk, you can go ahead and do that. And maybe everybody should do that. But I just don't think the default position right now is fair or just, right?
Yeah,
Yeah,
100%.
I think it's the idea that like somebody should just be able to be normal and not a rocket scientist and go like work a job, whatever it is, and then receive rewards commensurate with his contribution or her contribution to society.
100%, yeah.
And that's it. Not have to be like a genius with money and you know, make all these investments. Just be like,
Yeah.
I'm going to work, and then I'm going to be prudent and take some of the money that I earn and set that aside, and that's for retirement. And
Well,
that
you're
should be
saying, I'm
enough.
just thinking the government should do the same thing. Like they should produce
Yeah.
value to society and take what they earn and
Yeah.
spend
Because
it
the
and don't
government
spend
never
more.
produces value, right?
Well,
No, I mean,
No, they
that's just
don't. Yeah.
nature. Government cannot add value to
well, that was what, like
any
50 years ago, you
transactions.
could like one income household buy a house, put your kids through school. Yeah, that's all the result of too much money printing.
Yeah, and I think that's where, I don't know, that's where we get a little bit worked up. Like, why can't we have that? And like, we know why.
We do know
because of
why.
money printing.
Yeah.
But like, that's
Like
wrong.
all
That's somebody
these
else making that
old
decision for us.
fashioned things like save your money, you know, blah, 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 it works, but not in this system, right?
Yes.
Like you're doing all the right things, but you're in the wrong system.
Yes.
So you need to get in a different system that allows you to do those things, which are the right things.
Yeah.
So we'll see what happens to the next.
So it's actually, so I have, there was a Bitcoin guy that I met. He has a bunch of big par policies, and I went through my whole thing with him, and he's getting rid of them. He's canceling them, buying a bunch of term insurance. And he sends me an email last week, and he's like, check this out. So it's whole life Bitcoin denominated insurance.
Wow.
And you basically, the premiums are, I ran an illustration for myself. I'm going to apply just because I'm curious. And I think the premium for me was, I think it's 0.25 Bitcoin a year for 10 years. And it's worth 3.1 Bitcoin at death. And that's over the short term, there's that spread. You're putting in a quarter of a Bitcoin, but you're getting 3. But over the long run, I don't understand it yet. I really don't understand it yet. I was supposed to meet with the guy last week.
We're going to have you back on in a year from now?
Yeah, he likes it because it's Bitcoin denominated, right?
Yeah.
Now the question is like, you're giving up your custody. Is it kind of worth it? And I thought to myself, I'm like, I'm trying to get my head around it. And I understand over the short term, like, but over the long run, like I still think about things in Canadian dollars.
Yeah.
So I'm like, at some point in time, if the Bitcoin maxi thesis is right and it's worth X a coin, let's go with Michael Saylor's 13 million a coin by 2045. I don't know. At some point in time, if it does become what we all hope it could become, which is the backbone, well, the returns will trail off, right? So the irony is that the Bitcoin insurance is only good, in my opinion, while Bitcoin is being adopted. Because once it becomes adopted, then you actually need to find something to invest, the fund who holds their Bitcoin in, like participating life insurance, right? Like if they just took in dollars and didn't do anything with it and paid you out in dollars, no one would buy it. They have to bring in the dollars and invest it. And the irony is, I was thinking about having a Bitcoin life insurance policy over the long run. The irony of the companies that are selling Bitcoin insurance is that eventually, if Bitcoin becomes successful, they will have to invest their Bitcoin in companies because Bitcoin becomes so adopted that they can no longer become Bitcoin maxis, that they have to find returns in private enterprise because Bitcoin is now the stable store of value.
Yeah.
Well,
That will be an interesting.
I was
is-
thinking about it. I don't know.
I think the argument is that if you went fully to a Bitcoin standard, and I don't know if we ever would do that, but
Yeah, I don't even know what that looks like.
where it would just be enough to have savings because your savings would actually increase in value because it's a deflationary
Yeah.
environment. So you wouldn't have to go chase value, right?
Well,
right now,
like the whole idea that technology will continue to develop and improve,
yeah,
but instead of your money debasing, those gains in technology improvement would just be making
Right.
things cheaper, making things easier
Totally,
and
which it
faster
should,
and
yeah.
better, right? Like, and in a major way. too.
Yeah.
and that goes back to my point about why can't you just work and then save some of your money, and that's enough. In that environment, that would be fine.
Yeah.
Because you're savings would increase.
Totally. Yeah.
Due
that
to
makes
a
sense.
deflationary environment.
And it was a really interesting meeting. The whole idea of
Yeah.
Bitcoin life insurance is kind of cool. I'm going to speak to them again and run some illustrations. I'll send it to you. It's kind of, but
it's hard to come up with a quarter Bitcoin a year for 10 years.
Yeah, totally.
So,
right.
If you don't have any to begin with,
Yeah.
I mean,
or just sell your dollars for, it's just I really like term insurance, Bitcoin. I think that's a great idea, but permanent insurance, giving up custody. But what's cool is that because it's insurance regulations, you can get a loan on it as it grows, right? Just like participating life insurance.
Okay.
So they'll give you loans against it at 5%. The company's out of Bermuda.
What loan to value?
I think it's at 90% because
Okay.
the life insurance
Because
policy
you
get
can get
90%.
you can Lenin, you can get 50%, right? 50% loan to value.
Yeah,
loans.
I think so. Yeah.
I've done it. So
You've done it,
yeah,
huh? What do
yeah.
you pay on the interest rate?
I think
you
it's
pay?
12%.
See, that's a lot.
Yeah.
I lend out money at 12%. I
Yeah.
don't want to. That's.
I had to try it though.
Yeah,
It's
I
so
see
cool.
what you're trying to say.
If I put this money in and I want a loan instantly, boom. I don't have to qualify.
Yeah.
I don't have to send any documents.
Yeah.
You've become your own bank.
Become my own bank.
It's totally true.
All right.
Man. Okay, well, I think that's a good spot to end off. So
Yeah, totally.
we may have to talk again about the Bitcoin investment insurance policies.
Yeah, totally. I should have thought about it, right? I didn't know that this would take this Bitcoin turn, but it's fun. I like talking to you guys.
Well, you should know.
know?
Now you do know. So where can people get a hold of you, Adam?
Niman Financial Inc. Search that online. Search my name, Adam Niman. The websites, whether it's the benefit stuff or the insurance, it'll come up there.
Okay, and you've got the Fact or Fiction.
Yeah,
so
the
Fortune
ebook.
or Fiction?
Fortune or Fiction.
Fortune
I'm
or
actually rewriting it. I always have more ideas, especially with this, the Bitcoin stuff becoming more popular, the opportunity to invest and trying to expand on it. Also, I've over time just refined my pitch. I felt like previously it was all over the place, and I'm trying to zero in on a few core points even more. Yeah. But I'm hoping that I can continue with the rewrite and release it sometime, maybe in the new year.
Yeah.
I said that a year ago, but yeah.
Yeah, no, it's a good resource. It's not a long read, right?
No,
so,
not.
Yeah, perfect for understanding what we're talking about. So thanks very much for coming on,
No,
Adam.
thanks for having me again. Enjoy
and,
this. Thanks,
until
guys.
next time.
Steward your wealth wisely. Thanks for listening to this episode of the Two Stewards Show. If you like my voice better, click subscribe.
If you like my voice better, click share.
If you like both, give us a 5-star rating.
To learn more about the show, head on over to twostewards.ca and explore our free resources. To interact with the show, feel free to reach out at hello@twostewards.ca.
We will see you in the next episode. In the meantime, steward your wealth wisely.
Nailed it.